Every price movement in the market, no matter how large or small, is driven by one law, the law of supply and demand. It governs every rally, every collapse, every trap, and every fortune ever made or lost in speculation. It's the invisible force behind every chart, every candle, every tick. Traders like to complicate it, dressing it up with fancy terms and countless indicators, but strip it all away, and you'll find that price only moves when demand overpowers supply or when supply overwhelms demand. Everything else is noise. The greatest traders in history understood this law intimately. They didn't fight it, they aligned with it. But most traders today forget that markets are not built on logic, they are built on emotion. And emotion is what shifts supply and demand. When fear surges, supply floods the market. When greed rises, demand takes over. If you can learn to read those shifts before the crowd sees them, you'll never need another trading system again. When I first began trading, I chased every price movement. I thought the market's randomness was opportunity. I was wrong. I was watching the surface, not the current underneath. It wasn't until I began studying where the largest players were placing their money, where accumulation and distribution were happening, that I finally began to understand what was truly moving the market. The big money doesn't shout its intentions. It whispers them through subtle imbalances in supply and demand. You can always see the footprints of accumulation before a rally begins. Price stops falling, volatility contracts, the market begins forming higher lows even though news remains bearish. The public gives up, volume dries up, and yet price refuses to break lower. That's not weakness, that's quiet strength. That's demand silently overpowering supply. Smart money is buying what the crowd is throwing away. The same happens in reverse at the top. Prices rise fast, euphoria spreads, and the crowd starts buying because they fear missing out. But notice the subtle changes. Volume peaks, momentum weakens, price makes new highs but fails to hold them. That's not strength anymore, that's distribution. The professionals are selling into the demand created by the public. It's the oldest trick in the market. Sell to the crowd when they're desperate to buy from them when they can't stand to hold any longer. Supply and demand are not just concepts, they are emotions made visible through price. And if you can learn to read emotion in the market, you'll see what others can't. The market is a crowd, and every crowd behaves the same way it always has. Greed, fear, hope, and panic, they repeat generation after generation. The forms may change, but human nature doesn't. To trade with supply and demand effectively, you must train your eyes to see the zones where imbalance is most likely to occur. These are not random levels on a chart, they are points where the battle between buyers and sellers was most intense. Look for areas where price moved aggressively away from a level with strong momentum and volume. That's the fingerprint of institutional action. That's where smart money placed its orders. When price returns to those areas later, that's where opportunity lives. If it's a demand zone, you'll see buyers step in again, defending their previous positions. If it's a supply zone, sellers will reappear, pushing the price back down. But remember, not all zones are equal. The best ones are fresh, untested, and backed by strong movement away. The weaker ones have already been touched, meaning orders are likely filled and imbalances resolved. The reason this strategy always works over time is because it's built on the core truth of the market. It focuses on the cause, not the effect. Price movement is the effect. The cause is the imbalance between supply and demand. When you learn to identify the cause, you stop reacting to the market and start anticipating it. But make no mistake, applying this law requires discipline. Most traders fail not because they don't understand supply and demand, but because they can't wait for the right moment to act. They draw dozens of zones on their charts and convince themselves that every movement matters. It doesn't. The key is to be selective. Only trade the clearest, strongest zones with visible imbalance. Quality over quantity. One great trade is worth more than 10 impulsive ones. There's another element that separates professionals from amateurs: confirmation. Just because price touches a zone doesn't mean you enter blindly. You must let the market confirm that demand or supply is actually active. Look for rejection wicks, failed breakouts, or shifts in momentum that show buyers or sellers defending that level. When you see that reaction, that's when you strike. Timing without confirmation is gambling. Every trade you take based on supply and demand should answer one question. Who's in control, buyers or sellers? If you can't answer that clearly, you have no trade. The market doesn't reward uncertainty. Wait for the imbalance to reveal itself. The patient trader always profits from the impulsive one. There were times I ignored this principle and paid the price. I'd see what looked like a perfect demand zone and enter too early, trying to predict the reversal before it happened. The market would push deeper, triggering my stop, and then reverse right after. That's the penalty for impatience. The market loves to test your discipline before rewarding your insight. If you can wait until everyone else gives up, that's when your timing aligns with true opportunity. Another truth about supply and demand, it scales across every time frame. The same principles that work on a 1-minute chart apply to the daily or weekly chart. The difference lies in the magnitude of the move and the patience required. A daily demand zone may take days or weeks to form and trigger, but when it does, it often leads to powerful, sustained trends. The higher the time frame, the more significant the imbalance. That's where the big money moves. Many traders today try to outsmart the market with automation, signals, and complicated algorithms, but all of them, in one form or another, are still responding to supply and demand. Computers can execute faster, but they still obey the same natural law. You can't escape it. It's the foundation of every price chart in existence. When you trade from the perspective of supply and demand, your mindset shifts. You stop fearing market manipulation because you understand it's just the process of rebalancing. You stop chasing entries because you realize opportunity is always forming somewhere. You stop overtrading because you see the beauty in waiting for clear imbalance. In short, you start thinking like a professional. Let me tell you something. Every great fortune in trading was made by someone who learned to sit tight when they were right and stand aside when they were wrong. The law of supply and demand teaches that truth better than anything else. Once you're on the right side of the market where demand is rising and supply is shrinking, stay there. Don't sell too early just because the price moved in your favor. Let the imbalance play out fully. The biggest moves come when others are still doubting. But also, know when the tide turns. Every demand zone eventually loses strength as buyers exhaust themselves, and every supply zone weakens when sellers run dry. Your job is to recognize when the imbalance shifts. That's where new trends begin. Don't fight the change, flow with it. The market isn't your enemy, it's your teacher. It rewards awareness and punishes arrogance. Risk management, as always, is the foundation beneath everything. You can identify the perfect zone, time it perfectly, and still lose money if you risk too much. No setup is guaranteed. That's why you size your position small enough to survive multiple losses, because even with the best supply and demand setups, the market will occasionally do what it must to humble you. Consistency comes not from avoiding losses, but from controlling them. When you finally master supply and demand, trading becomes simpler, not easier, but clearer. You start to see the market for what it is, a constant dance between fear and greed, buyers and sellers, accumulation and distribution. You'll stop asking why the market moved and start asking where it's most likely to move next based on imbalance. Here's the greatest secret. Supply and demand never lie. Indicators can mislead, news can distract, opinions can distort, but raw price always tells the truth. It's the purest expression of the crowd's psychology. It shows you where traders are trapped, where they're confident, where they panic. If you learn to read it, you'll see through the noise. I've seen men ruin themselves chasing trends they didn't understand, and others build fortunes by simply buying when everyone else was afraid and selling when everyone else was greedy. That's supply and demand in its simplest form. The logic is timeless because human behavior is timeless. So, when you open your chart tomorrow, stop trying to predict the future. Instead, identify where the crowd is likely wrong. Look for areas where fear is creating excess supply or greed is creating excess demand. Those are your opportunities. Then wait for confirmation, control your risk, and act with precision. That's how you trade like a professional. Supply and demand is not a shortcut, it's a discipline. It teaches patience, objectivity, and respect for the market's natural order. It rewards those who study deeply and punishes those who act rashly. But if you commit to understanding it, truly understanding it, you'll never need another strategy again. Because no matter what markets do, no matter how technology evolves, the law remains the same. When demand outweighs supply, prices rise. When supply outweighs demand, prices fall. Everything else, every rumor, every chart pattern, every system is just an echo of that eternal truth.